Thanks very much, Ali, and thanks very much for the invitation and the feedback. Yes, thanks. Okay. Is that why? All right, thanks very much. The Cum-Ex is a critically important issue for the business. It's something that, so I've been doing securities lending. When I did my first trade, I had a full head of dark, long hair. So I was 1981. So I'm hopefully getting the hang of it now. And I'm really looking forward to this conversation because quite frankly, this topic and dividend arbitrage, yield enhancement has come up with all kinds of euphemisms over the years. It's something that hasn't been discussed openly. And I think that, as many things will bear testament to, when you don't talk about things and it's all kind of hidden in secret, the reality is people fill in the blanks. And so there's a lot of assumptions that things like securities lending and dividend arbitrage and yield enhancement techniques are evil and bad. And when you have something like Cum-Ex come up, it kind of reinforces that. So what we're going to try and do today is talk about what it is, what the issues were, what lessons have been learned. So that's the objective today. And I think as we just heard, I'm fortunate to be with this with my colleague on the panel here. You heard his book. Here's his book. I have his book. I learned stuff about this as well. So now the thing is, I told him that I was going to ask him to autograph it. It's even more valuable now after the award. So Richard will take care of that. But look, what I do, I run my own consulting business, Pierpoint Financial. Again, without Ali, I wouldn't be here, obviously, because he invited me. But look, when over the years, I've encountered tax, mostly reluctantly. And in this room, I'm the least qualified tax person, no doubt. I know less about tax than just about anyone in this room. And that's good. That allows me to ask questions when I don't know the answer. And hopefully that'll be part of my role today, is ask questions on your behalf. But please, if you have a question or something isn't clear, ask it, because I guarantee you someone else in the audience, either here or virtually, will have that same question. And Richard knows that I'm going to interrupt them along the way, so please feel free to do that. I help advise customers, whether they're investors, intermediaries, or fintechs, on product development in the space, on risk management and revenue generation. And we extend out to things like equity swaps and custody as well. So that's enough for me. Richard, you've had a heck of an introduction already, but I'm still going to give you a minute or two to talk about yourself.
Well, we shouldn't do that, for sure. I used to be a practitioner, and now I'm an academic who does some practical work on the side. That's probably enough about me.
Okay. That's very humble. That's why he gets awards. You see, that's the key. Right. So the Cum-Ex scandal, it's the gift that keeps on giving, right? You're talking about something here where it's about bankers abusing the system, and people love to hear about things like that, especially when it's public. There's you can look at it superficially and say that there have been transactions where they have made undue amounts of money. But there's also really deep conspiracy theory things here. So you can look at files that go into dark corridors, hidden rooms, and conversations, and cloak and dagger aspects of it as well. So there's quite a lot of information that's available publicly. And of course, this has not only led to convictions, there are ongoing cases, and no doubt there will be cases yet to come. So it will be with us forever. A couple of things. Number one, stock loan is just a transaction, right? It's neither good nor bad. It can be used to, and I can point you to regulators that say it's good for price discovery, market efficiency, systemic risk reduction. So it can be used carefully there and used well, or it can be abused. And that's really what the case is. But it's just a transaction. And I think, Richard, you may come across the point that it can be used, these transactions can be done as securities loans, but also other transactions as well. So it's not, don't look at the transaction type. Don't assume that stock loans are bad or good. Look at how they're actually being applied. And if you're involved with it, how you and your firm oversees that activity. It's kind of like a car. I think you can use your car to take your grand to her medical appointment. or you can get drunk and get behind the wheel and be at risk to yourself and others. So it's just a thing. Even dividend arbitrage in itself isn't illegal. If transactions are properly constructed and contain the right components and real risk in the market, then that's acceptable to regulators as well. And we've seen reports from regulators that don't say this is evil, stop it. It says pay attention to how people are using this and make certain that you are vigilant in how you oversee the activity. So all of that having been said, again, I'll encourage you to ask questions along the way. But I think as a starting point, Richard, what the heck is Cum-Ex?
Well, can I start by answering a different question, which is why we should care about Cum-Ex? Because I'm just sort of conscious that I spent about 2 years of my life working on Cum-Ex in German, which is worse and most difficult thing I've done. So I'm just sort of putting myself in the position of the audience. So why should you care about Cum-Ex? Maybe I could start that with that and then just go on to what it is. There are a number of reasons, but I'm just going to give you a practical reason and a technical reason, if I may. The practical reason goes back to comments that Ali made actually about trust, which might sound an odd thing to say. I would say that in the areas that we care most about relating to tax and the financial sector, I would say that Cum-Ex has been the single biggest destroyer of trust between tax authorities and taxpayers in the last 20 years by some margin in Europe. So, and we care about trust pretty significantly for reasons we'll probably get onto in the conversation. We care about that pretty significantly. So Cum-Ex is a source of problems in this zone, particularly, for example, trying to get reclaims done with tax authorities. Cum-Ex is a massive in that for reasons we've got. The other technical reason, if you look at Cum-Ex, and Roy and Ali have both referred to the book I wrote, Banking on Failure. You might say, well, what failure does Cum-Ex illustrate? And the answer is that everything failed in Cum-Ex. Cum-Ex is a demonstration of complete and utter failure. The only thing that worked really well for a certain time is the monetization of failure by the banking sector. That worked pretty well for a number of years, if you think that's a point to highlight. Everything else failed, completely failed in ways we'll go on. So my technical point is that Cum-Ex is interesting because it's a high point of failure of the system and all parts of the system within it. And that carries lessons, or potential lessons, for various things like policy, how you respond to that, and so on. So that's why I'd say Cum-Ex is worthy of thinking about or discussing. Should we go on to what it is? And what it is the biggest problem for somebody like me, because Cum-Ex is incredibly complex, and so complex. The complexity of it becomes a problem in articulating what it is. Now, I should say that I think you can address some of the practical and technical problems of Cum-Ex without really fully understanding it. And it'd be a bit controversial to say that's probably what a lot of regulators are doing. That might be rude, so I won't say that. But
I could say something like that, and it would be less of a problem, right?
Indeed. Yeah.
Okay.
But notwithstanding that, we're just going to have a quick go at trying to explain what it is, so people get the idea. And obviously, everything I say is oversimplified. So just bear with me if it seems that way. Now, before we come to the slides, can I just give you the example? If I sell my car to Roy right now, let's say I just sell him my old banger of a car, he gives me £10,000 or something. We've done a deal. He owns the car right now. Okay, but it's going to take a while before his ownership of the car filters through the system. In other words, that for those of you who know, DVLA in Cardiff is the main body that organises the registration of owners. So I'm going to have to send a piece of paper to DVLA that I've sold the car and he's the owner. And in probably, I was going to say a week, but it might be a month or two, he's going to be the registered owner in the system. Okay, so what that illustrates is that ownership can pass immediately at law. He is the owner as soon as once he's given me the £10,000 and we say done deal, we've got a deal, he's the owner of the car. But in terms of the system catching up, it's going to take a few weeks for him to be the registered owner. Now, the reason I mention that is because understanding the difference between an immediate the immediate contract effect and the system catching up is pretty significant in the context of Cum-Ex. So, and the other thing we know about the car is that it's just a single asset. I've just sold a single asset, he's bought it, end of story, we're done. If it were a parcel of securities, we might have to worry not just about the parcel of securities, but about the corresponding income. Right, so what do we do with the income? If I sell him a car with income, i.e. parcel of securities with income, and the income was going to be paid to me, but I sell just before it's due to be paid to me, so it should go to him. The system might send it to me because it's not responded in time, and I need to find a way of moving it on to him to make this all work properly. And just got 3 simple slides that show how that works and where the glitch in the system is that gives rise to Cum-Ex. So just bear with me if I go through these 3 slides, if that's okay. So the first slide, what that's trying to show is I'm going to be the seller, Roy's going to be the buyer. What that's trying to show is that on the 25th of May, step 1, if you look at the horizontal line at the top, on the 25th of May, I sell him a parcel of shares, cum-div, which means a dividend is coming up, right? But it's not yet been paid. So this is exactly the situation I referred to. I'm selling him something with an income event that hasn't yet happened, meaning that because I'm selling him before the income event, he's going to be entitled to the income, not me. But because I might not register the change in time, the income might come to me, so I've got to find a way of passing it on. And that's all this slide is illustrating. This is me selling on the 25th of May to Roy this parcel of shares on which a dividend is due to be paid. He pays me some cash, gone down a little bit from my £10,000 here, but no matter. At step 2, which is the if you look to the left, step 2, the actual company whose shares I sell pays a dividend. This is tomorrow. So in other words, 25th of May, I agreed to sell these shares, which will cum div. Next day, the dividend is actually paid. The system has not recognized the sale of shares. It's not had time. It's like DVLA tomorrow, needs another couple of weeks to recognize this. And so what it does, it pays me, the seller, the dividend. And that, you can see that coming across on the diagonal line on the left of the page. So I've got to find a way of getting the payment across to Roy, the buyer, because he's effectively bought cum div. That means he's paid for the shares and included an amount corresponding to the accruing dividend. That's what buying cum div is. And the way that's done under the clearance and settlement process is illustrated on the slide. Let's say that the dividend is €20. What the clearance and settlement process does is it recognizes the proximity of the sale to the dividend payment date. And so it's able to say, well, we understand now what needs to happen. We understand that we need to take the dividend from Richard, who's received it, and give it to Roy. And that's exactly what happens. So you can see that from a seller's perspective, if you compare the 2 diagonal lines 2 and 3, they'll net out. I get the dividend, but it's taken away from me totally. And then look at step 4, it's actually given to Roy. That's exactly what should happen. He's paid me, let's say he's paid me whatever for the shares, including paying me for the dividend. So I should not receive the dividend and he should. This mechanism achieves that. See, that straightforward, nothing counterintuitive, makes sense. Let's go on to the next slide. And the only thing we're going to change is what happens if there's withholding on the payment, on the income payment. Okay, so so all the facts are the same, but just look at the bottom left now. So instead of the dividend being 20, it's 15, and it's a lesser amount than 20 because we're paying withholding of 5. So Exco has paid 5 of withholding, and so only 15 comes to the seller. So how does the clearance, how does the process now work? Answer, well, it recognizes that I've only received 15. So you shouldn't take away 20 from me because I'm out of pocket, I can't fund that. So it takes away what I've received, the 15. You can see that again in the in step 6 on this diagram. And just like the last diagram, at step 7, whatever it takes away from me in terms of cash is given to Roy. But we haven't yet dealt with the tax credit. And so the way we deal with the tax credit in this system is that I've sold the shares so I do not use the tax credit. In other words, it's irrelevant for me. And the clearance and settlement process effectively recognizes, I'm oversimplifying, that the buyer is entitled to the tax credit. Okay. Now, mission accomplished again. Everything that needs to happen has happened. I've sold Cum-Div shares to Roy. I happen to have received some income after the event. That income has been entirely moved on to Roy, and the tax credit has been moved effectively from me to Roy. Everything is exactly as it should be.
And Richard, this is what happens every single day all across the world. This is a normal occurrence, right?
Yeah,
Trades get sold just before dividend date sometimes.
Yeah.
Tax credits happen, vouchers get issued. You have added clearance and settlement all into one bundle. That is complicated and detailed, but it is the essence of it. So there's nothing unusual. This is what the world is.
Not at all. It is just all common sense, makes etc. Now, the reason this is so obviously the right result is because I owned the shares beforehand and I've passed them to Roy. So instead of me receiving the dividend and the tax credit, Roy should. Right, easy. Now, conceptual question. What then happens if I sell shares short? Okay, so the concept that we've achieved is that where I'm selling long, in other words, where I own the shares or the car, okay, all of this happens. And the reason it happens is because if I'm selling shares I own, I'm selling shares, they need to go to Roy. I would otherwise have received the income. So we need to adjust that income across. Now, the conceptual question on a short is, if I short sell, am I going to receive the income in the first place?
So just clarify for anyone that's not clear on short selling, that's where you're actually selling a security that or currency, literally any asset, selling an asset that you don't own. And of course, because the buyer from you expects delivery of that, and you can't get your proceeds until they receive delivery, you have to find some way of delivering that. So you borrow it, whether that's a stock or a bond or, going overdrawn in your currency account, whatever it is. So I don't own it. I have to find a way of owning it temporarily so that I can deliver it to you.
Yeah, but the critical point is I do not own it. And so you would think that this adjustment mechanism is not going to apply, wouldn't you? Why would it apply, since there is no need to move the dividend that I receive because I don't receive a dividend? So why would you have an adjustment? It doesn't make that's the point, anyway. So let's actually have a look at what happens if there's a short sale. So we can go to the next slide, this last slide. I know this is slightly tedious going through these slides, but this is what actually happens. And the answer is, what happens is exactly the same thing. Exactly the same thing. You could say, you could express this as the point that the settlement system does not have the ability to distinguish between long sales and short sales. It just assumes, or alternatively, that it just assumes that if there's a sale, it's a long sale. Now, that's quite a critical assumption, because let's look what happens on this. The shorts, so if I'm short selling to Roy, I don't have the shares. I've got to find the shares after the event. So what this slide is illustrating is I short sell to Roy, meaning I don't have the shares, on the 25th of May. On the 26th of May, a dividend is paid and the dividend adjustment mechanism carries on as normal. I need to find the shares to give Roy. So if you look at the left-hand side of the page, what this is showing is that the Exco is actually paying a dividend up to a potential lender. So it's some third, it's Ali. Ali's the lender. And he's actually going to be holding the shares, getting the dividend, investing it very wisely, no doubt. But after he's done that, after he's got the dividend and invested it very wisely, I'm going to borrow his parcel of shares, ex-div. Okay? And that's what this is trying to show. By the 27th of May, if you look at step 4, top left, they're ex-div shares. So I deliver them. He delivers them to me. Now I have ex-div shares. And I can deliver my ex-div shares to Roy, who has no idea whether I'm delivering, whether he's no idea whether I'm a short seller or not, because he just gets his shares in the normal way. But look what the system does. What the system is doing, if you look down bottom page, it's doing exactly what it did before. So it's effectively generating this tax credit of 5. So what would you observe from the whole page? Well, you can see 2 people seem to be getting a tax credit on the sort of same parcel of shares. And the 2 people are the lender. This is Ali before he lends the shares, is getting the tax credit at the 15 plus 5. That's what he's getting in the system. And then the buyer is getting the 15 plus 5. So what Cum-Ex, basically trying to answer the question about, well, what is Cum-Ex? Cum-Ex is broadly the trade structuring that is designed to stimulate this system so that it produces lots of double tax credits, very roughly and oversimplistically. Cum-Ex is trying to exploit and monetize this. Can I call it a flaw in the system? I mean, it may or may not be a flaw, but it's sort of loosely understood as a flaw in the system. So that's what Cum-Ex is trying to do. How do we do that? Well, as Roy has kind of indicated, you'd often do it by short selling and stop borrowing. But you don't have to short sell and stop borrow. You can find other ways of doing it because there are multiple ways we can do the same thing in financial services tax. So that is sort of what Cum-Ex is. It's trying to exploit a flaw in the system.
So effectively, you're talking about 2 people getting a tax credit on 1 parcel of securities.
Very, very loosely, yes. Remember, so far, what does the buyer know about this? On the basis of these slides, nothing. So when we say two people, it's a sort of, there's a whole set of separate questions as to who knows what and when did they know it. If you were a lifelong tax planner extraordinaire, what you'd say is lovely about this slide is that the benefit is generated by the seller, who is not involved at all in the use of the benefit, because that's the buyer. And the buyer, on this basis, on this oversimplified basis, the buyer has no idea that this has happened. So I wouldn't say it's a perfect tax planning scheme, because it's obviously not, but you can see those elements.
Okay, is that clear to anyone? Does that bring any questions to anyone's minds? No? All right.
So I'm assuming that everybody gets that one way we might do this is that I might be a very cynical short seller. So I'm just going to find a stock that I can short sell to Roy, who is, knows nothing about this. And so my strategy is going to be short selling to Roy, borrowing ex-div shares and delivering them. And I make some money through that. And the reason I make money is because when I short sell, he's paying me for the dividend. And as we all know, when you're paying for the dividend, you're recognizing what you're going to get and what the tax features are. So if you're if you're going to get 15 plus a 5 credit, which has value to you, you're very unlikely to be paying 15. You're going to be paying 15 plus something. So that's where I'm effectively monetizing in the pricing of the sale the value of the tax credit. So this is essentially what Cum-Ex is. Now, I'll spare you the 2-year version.
Right. So why is that a problem? That all sounds pretty straightforward. And as you say, we're all making a little bit of money there. No one seems to be getting anything they're not entitled to.
So everybody wins, apart from one party, and that is the tax authorities. The tax authorities just net lose on this. And you can very well understand tax authorities saying this is not, my intention is not to allow a glitch in the system to generate this result. And indeed, if you look at this slide, how much withholding tax do I collect? 5. How much do I effectively pay out or credit? Answer, a bit more than 5. I actually seem to be paying out 2 5s to the lender and the buyer.
Oh, okay. No, I was just really tempted to press this microphone. No, it's interesting what you say, Richard, because if this has been going on for 20 years, let's ask that famous question that the Queen asked at the London School of Economics. Why didn't anybody see this coming? For 20 years, revenue maybe wasn't what the authorities were expecting, but now why all of a sudden has it become an issue?
Well, it stopped being an issue. Mostly when people talk about Cum-Ex, they talk about the German market. That's the big market. That's where a great deal of the transactions were done, although it's been done in a number of other markets as well. In the German market, it stopped being an issue in 2012. So it's got, and in other markets, different time periods, some later than that. So I would say the issue now is not so much about, certainly for me, from my perspective, the issue now is not so much, is this still going on, this very particular trade still going on, is it still going on, and what do we think about it? That's pretty much answered. It's not going on. So the issue now is the sort of legacy of it, and so I would return to the comments I started with, which is it's got a number of different aspects, but to pick 2, the practical one is it's the single biggest destroyer of trust in an area where trust is needed in the last 20 years, and the technical one is it illustrates a complete failure of every part of the system that should have worked better. And that, well, if you care about that, that's relevant going forward.
Yeah, and to your point of surely people knew about this, I can tell you in the mid-90s, the Italian tax authority did an assessment of who owned Italian shares before a dividend date, during a dividend period, and after a dividend period. And it seemed that there was a huge shift where there was quite a lot of foreign investments before the dividend date. Around the dividend period, 80% of the shareholders turned out to be Italians. And then it went back to its historical norm of only 40% being owned by Italians. That was the mid-90s. Now, one of the ways that they actually dealt with it is they didn't pay any tax reclaims. That was the easy way to do that. So, but that's probably not the best way of dealing with things.
Well, if we're trading histories, I can trump that and go back to the 70s, because the German parliamentary report on Cum-Ex identifies that the tax authority was aware of these issues. They were being discussed in the 70s in Germany. They were also discussed in the 90s and so on. So it's a great question about, well, how can that be? And that raises questions about awareness of market practice and awareness of significance of things. You can understand something, and so you can understand there's a glitch like this. And, maybe you take the view, well, this is pretty extreme circumstances. This would only happen in very limited cases. And you just fail to realize the incentives and reality of financial services, of the financial services markets, that you are creating incentives for it to be exploited. And that's going to happen, isn't it?
But look, let's just sort of carry on with that then. So you've talked about a transaction. Any sense for sort of the scale? Because that one of the issues is one of the interesting points in the book is you talk about and try to say that, look, you could say that if this is determined as an abusive transaction, there might be a few people that know about it and exploit it, and there's some bad apples. But you actually make the argument that the scale of it and the extent of and reach across so many organizations is such that it's not about bad apples, it's about sort of culture, and that's a theme throughout the book. So I'm wondering if you can talk about that a little bit.
No, that's right. The history of there is a lot of in fairness, there is a lot of misconduct, for want of a better word, in financial services or based on financial services tax. That's been a feature of markets. Roy referred to the Italy example in the mid-90s. There's also a number of other cases where tax authorities suddenly realize that they want to change the way they deal with things, or they need to change the way they deal with things. So the normal way that people respond to these issues is a kind of it's almost like a sort of tabloid response, which is an apportionment of blame. So typically in Cum-Ex, the biggest response you'll see publicly is stories about naughty bankers living very lavish lifestyles. And so this is the bad apples theory. We've got some bad apples in the world who just exploit improperly these situations. Now, I'm not saying that's wrong, and I'm not criticizing that. I'm just saying it's a completely inadequate response to these sort of issues. And what I try and argue in the book is that there is a complete nutter. I've said this a couple of times, so apologies if I'm boring everybody, but there's a complete nutter failure of everything. There was a failure of the system, there's a failure of regulation, there's a failure of internal control. The tax authorities were not great, etc. Everything failed. And so I think it's much more interesting, and this is the second reason I gave, the technical reason I gave, as to one you might be interested in Cum-Ex. Much more interesting is to try and see this as emblematic of failure in the way we do things, in the way we govern the tax systems at that level, and tax systems and their interaction with other regulatory systems. So that is kind of what the book is trying to encourage, is, well, let's give that some thought, because what's implicit in that is that this is not an isolated case. This is emblematic of a theme.
Yeah, so look, having spent most of my career working for one of 10 different banks, look, your job at a bank is to make money.
Yeah.
And if something like that is legal and you have an opinion that allows you to do it, why wouldn't you do that?
Yeah, okay, I mean, you're encouraging me to talk about opinions, which is a bit of a side point, but opinions generally, I think one should be a little bit skeptical about. Many tax opinions, the place to really read, the thing to really read is the assumptions. And my observation would be that very many tax opinions assume away the really critical factors. So on a detailed point of response to your question, I think more skepticism about opinions is warranted. But on the wider point you raise about should we exploit tax features of the system, we think about what double tax treaties do. Double tax treaties effectively give tax benefits to encourage investment, don't they? They do things like reduce withholding tax, give tax spared credits, or they do something like, or give you some, maybe argument is they give you certainty as well, but they do certain things that are designed to encourage investment. So what's behind your wider question is, well, can we take advantage of tax features? So it seems to me that the point of principle is clearly yes. Where we can have the big debate is who should take advantage and in what circumstances. And so then we start getting into the weeds of the detail. Is this in these circumstances permitted or not?
So again, really following on from the question, like this hasn't necessarily been a complete surprise to tax authorities along the way. And the Germans in particular, as you said, they found it in the 70s, or they talked about it in the 70s, but they found it, they looked at it, they checked what was going on, and they brought out new regulations, and they've been through this process, and it took them a few goes. So I don't know if you can give some background to that.
Sure, sure. I think if I were making the claim for the defence, I would say that up till the late 1990s, the German tax authorities didn't really appreciate what this was and the significance. But from about the late 1990s, that's quite hard to make that argument. Certainly by about 2003, there was a sort of there was an ongoing dialogue with the Federation of German Bankers about this issue. So that was in 2003. It took them then in 2005, they started thinking about legislation. That came in 2007. And this was legislation to regulate this, sort of basically deal with any problems. The 2007 legislation basically said that if I'm the seller and you're the buyer, we're going to impose a withholding tax on the compensation payment, which is the effectively the if you look at this diagram, you can see the payment that's made by the short seller at step 6. Okay, so we know that the problem with the short sale is that there are 2 people getting the benefit of the 5 tax credit, but only 1 payment of that tax credit. So what the 2007 legislation did was imposed a withholding tax effectively on the compensation payment from the short seller at step 6. And the idea being, well, if we can impose, this is very similar if you're familiar with it, with the approach that used to be adopted under the UK manufactured dividend rules. If we impose another withholding tax somewhere in the chain, then we're going to have had 2 goes of withholding tax, and we can give 2 credits, so we're all fine. But unfortunately, the 2007 legislation did that and said, well, we're going to impose this where we've got a domestic bank settling this. So where we've got Richard selling to Roy, and they use a German domestic bank to settle the trade, this solution will apply. Now take a really wild guess as to what would happen, and whether you think the business of German domestic banks would go up or down following this announcement. And equally, whether you think the business of non-domestic German banks who are outside this legislation would go up or down. Yes, you've guessed it. Overnight, everything shifts into non-domestic settlement agents. So this ended up being pretty useless as a mechanism. Actually, it was worse than useless, because the market assumed that if the tax authority is saying that in these very specific circumstances, you must have a tax obligation, the market assumed that the implication was, well, if you're not in those very specific circumstances, which I assume somebody's thought about, because otherwise they wouldn't have made them very specific, if you're outside those, you don't have the obligation. So a byproduct of the 2007 change was actually that it encouraged participation.
Yeah, look, and that's not unreasonable. As you said, if the tax authorities say there's a problem here, we've addressed the problem, and here's the new rules, please operate by those rules, and then banks operate by those rules, why is that a surprise that everything shifted?
Indeed. And then just to complete the story, there was a later process, a very similar process, but an administrative one that happened later in 2010. And broadly the same result happened. So what you can observe from the history of the way this has been dealt with is that you've got a very long time in dealing with the problem, successive attempts to do that which fail and actually encourage trading and internationalize trading. So this would not be, but by the way, I just got to say, at the same time as all this was going on, the OECD issued a publication about cooperative relationships. And guess which tax authority they held up as the shining example of a cooperative relationship with banks who are faultless in their exchange of information and knowledge of what was going on in the sector. Yes, you've guessed it, it was the Germans. Yeah, so.
We have a couple of questions in the audience, but let me just make comment. A manufactured overseas dividend regime. All that did as a borrower, I spent most of my time as a borrower rather than a lender. Both sides. We didn't borrow from UK entities, so all that happened was UK institutions lost income to the benefit of non-residents. It was a regime that actually discouraged you from trading with UK entities. A question there.
Hi. So, firstly, fantastic session, really brilliantly explained. So I'm Simon York, I work for HMRC, so the UK's tax authority, and as you know, fortunately, we weren't hit by this because of the nature of our tax system for corporate taxation. I'm not an expert on this. I've not read your book, although I think I'm going to hunt it down now. And I'm interested in the behaviour point that you made here. So some of this could be mistakes. So we've got a system there that doesn't really give the effect that it should give. You get 2 tax credits rather than 1. People didn't know that. 2 happened by mistake. Or it's, as you described, tax planning, taking advantage of that. I had up HMRC's fraud investigation service, and I would say if I thought people were deliberately trying to engineer a situation where 2 tax credits were paid when only 1 was due, that sounds like fraud to me. Any thoughts?
Yeah, so, and that is indeed is what's happened in Germany, is that as the discussion's gone on, so if we just look at this, we could ask ourselves, what's going to happen in the real world with this glitch? Now, it is possible for a short seller like me to say, well, I'm just going to basically find people in the market who don't know what's going on, and I'm just going to find people like Roy that doesn't know anything that's going on. He wants to buy some shares, so I'm just going to short him whatever he wants to buy, and that's where I'm going to do it. So, do we think that is likely to happen as a sustainable model in the market? Now, I would say probably not, because I would expect that, based on my knowledge and working in the sector, I would expect that this is going to be perceived as too good an opportunity to be missed. And I would expect that the question is going to be, how do we industrialize this process? That's just what I would assume. The market will move to industrialize this process. And the trouble with just Roy wanting to buy is that I can only make money when he wants to buy the shares for reasons other, for whatever reason. But I want to find loads of people who want to buy. And I don't really care if they want to buy them or not. So I want to try and, the way that I might be able to do that is to try and insulate them from risk. So, and that gets to all the other structures. So can I sell him? This may sound familiar to those who are involved in the dividend arbitrage market. Can I sell him something which he might not hold for terribly long, and then recirculate it and so on? So that's where this goes to. Now, whether that's fraud or not, I don't think you can. Whether or not it's fraud is going to turn on the exact market. It's going to turn on the exact manner of execution, and that's going to raise a lot of really, really difficult questions. And actually, another question it does raise, and as I say, this is what's happening in Germany. There are fraud.
Yeah, I mean, it'll turn on whether it's dishonest or not, won't it?
Yes.
If someone is dishonesty and knowingly doing it.
Whether parties knew what was going on, but there are still plenty of difficult issues. And one issue it does raise is tax, or for the reasons I said, the seller and buyer are probably going to be by the end of Cum-Ex, they were all internationalized. So they weren't in Germany. Well, not many of them were in Germany. Then that raises the question about how do you prosecute or how do you investigate a cross-border fraud inquiry, if that's what you're doing, involving securities transactions. And given that there have been 50 million of these transactions, the scale of what you're trying to investigate and the clunkiness of the mechanisms that are available for cross-border cooperation and make this an enormously difficult issue. Remember, what we're dealing, the underlying thing that's going on here is a really efficient globalized market, and that's being policed by lots of regional tax authorities that fundamentally are designed to operate within their own borders, and between whom the methods of communication, exchange of information are really, in Cum-Ex, have been really poor.
Where there becomes possibly less of an argument is the allegation that some U.S. pension funds were set up specifically to take advantage of this transaction as being one of the participants. Then you could question, and I think that's really, when you get out to that extent, it's an issue. But yeah, so it's a great question. Question here as well.
It was a bit of a question, but also a comment, right? What seems to have happened now is, the German government, the German tax authority, have taken a very hard line. They've gone out, they've raided a bunch of banks, gathered all of this information and evidence. To your point, who knows whether they'll be able to make heads or tails of it. It's a 10-year long investigation. But what that has done, it appears from our perspective, is pushed the risk people at the banks to basically shut all of this down, right? Because up until really the German example and the frauds that went on in Denmark and so forth, this was a bit of a game of whack-a-mole. And whether you want to call it Cum-Ex or dividend washing or dividend enhancement or whatever you want to call it, where you're parking money and taking advantage of somebody else's tax treaty, it used to happen a lot in one market, and then that market got wind of it. Italy maybe shut it down early. But Germany watched the Swiss shut it down. They watched many other countries shut it down. And the rules around it, to the point of being able to write an opinion that says, yes, you can do it if you do it this particular way, were very gray. And now it's just shut it all down. But it does appear that the governments were really toothless and feckless for a very long period of time, knowing that this issue existed and knowing that people were essentially taking advantage of tax treaties, which were meant to entice investment, not trading, but investment from people in other jurisdictions. Is that a fairly accurate kind of thought process around this? Because it does seem like they let it go for a really long time until they finally said, okay, enough is enough. And that was when the headlines hit.
Yeah, I think if I was a tax authority, I would draw a distinction between Cum-Ex and dividend arbitrage transaction.
Okay.
But that's, and I would kind of agree with the directions Simon's just indicated you come from with this trade. Although that's quite difficult. With dividend arbitrage, as we conventionally understand that is more problematic, it seems to me. Also, that's generally problematic, but it's not in the same league as Cum-Ex. But as I describe it, I've kind of given you a very simplified description of Cum-Ex. Once you get into the industrialization, and so, for example, let's take a really extreme case that, Roy is my brother, or we're very, very closely connected. And so I sell him something, we put a swap on between us. And so we are completely and utterly complicit. So we're just exploiting the mere legal ownership. He is legally a separate entity to me, but we're basically the same thing. If you get to that extreme case, you can see that the issues that Simon's raised are going to be much more acutely problematic, because we're just trying to exploit something we knowingly understand that we are cashing in on a tax credit.
Sure. No. Well, it's more difficult. There's definitely a difference between doubling essentially the number of shares through a market mechanism that actually exist versus a dividend arbitrage. But it all does seem to have been lumped in kind of the same.
Indeed. I mean, in Germany,
bucket from a management and process
one of the byproducts of the German experience was that after they looked at Cum-Ex, they then looked at what they called Cum-Cum, which is basically dividend arbitrage transactions, and they significantly tightened the constraints on that. And I guess that's the other point to come out of this. If you don't care about Cum-Ex, it's the legacy effect. This point, which has a number of legacy effects, but if you look at, say, the current work going on trying to simplify withholding tax procedures, in the European Commission. Personally, I would say that Cum-Ex is probably the most significant impact on that work, and pretty disastrous, because it's a real obstacle to getting back to some notion of trust. And because it's all really clever and arcane and all of that kind of stuff, unless you're a tax authority that's been doing this for 20 years, you're just not going to have the confidence that you understand what is a real issue and what's not a real issue. So I think it is causing a lot of regulators to worry about phantom issues.
And there's no question about that. If you look at what happened in post GFC, where regulators missed things on CDOs, as an example,
Yeah.
all of a sudden the growth of ETFs meant that ETFs became the next target for several years, where they said, oh, the growth of this is really exponential, and there's no doubt something really dodgy in here. So they started putting up papers on that, and that's just a lack of faith
Sure.
in it. So I think we have another question here, and then we're over time, I think,
Right.
already. So we're gonna have to wrap up.
Okay.
One of the things that strikes me, though, is that I'm interested in your comments and wrap up, Richard, on the challenge between tax authorities and their skill set, and then banking regulators that might look at trading strategy, what banks do and all of that, and the fact that those are often separate entities.
Completely.
And the challenges there. For the question.
Yes, I wanted, Stefan Gnutzmann, Germany. I wanted to comment on utter failure. I think this is not the whole story, but you already indicated that there's industrialized fraud by certain market players who work very closely together. And the one thing is a system has a glitch, but the other thing is to exploit it in an industrial way. And the other thing was also briefly mentioned, the lack of trust Mr. Kazimi started the conference with is now hurting many other people who are not at all part of this, and where tax law maybe is not fair yet. And that is the fallout of this industrialized fraud. And I would like to support the statement that what is called cum is a completely different thing than Cum-Ex. But we don't have the time to go into the detail.
Thank you. Look, I've been trying to sell people on participating in securities lending for 40 years now. And none of this actually does me any favors in trying to get people involved in business. So trust, it is all about trust. Fundamentally, everything is. Richard, maybe I can ask you to wrap up. Are there lessons to be learned? Are there challenges? I mean, where do we go from here?
We're short on time, so I'll be very, very brief. Loads of lessons, loads of really important lessons. You indicated one, which is the relationship between tax regulators and regulatory regulators. If you looked over the history of Cum-Ex, whose job was it to regulate this? Ask the tax authorities. Guess what they say? Regulators. Ask the regulators. Well, it's a tax issue. So there's some obvious lessons there. So I think very, very big lessons at a sort of macro level about policy, what kind of tax systems you should put in, how you deal with complexity. Guess who's best at managing complexity? Probably not the tax authorities that created slightly unfair. It's created by tax ministries and so on. But the people best able to manage and profit from complexity are those who are financially incentivized to do so. So a number of these sort of lessons, and then I think practical lessons. My own view is that, or my own observation is that many tax authorities tend to have models under which their people move around from one office to another. Whereas what you'll see in professional advisory firms, for example, or in banks is a deep specialization. That's just a small example where a tax official who's moving around the whole time is never ever going to develop the expertise to understand the real world implications of what's going on. Now that, in the case of HMRC, I'm not saying that happens. There are some people in HMRC with fantastic understanding of the market, but there are very few of them. And they always used to tell me when I was in practice that they were incentivized and encouraged to be moving. And so that's a small example. So I'm certainly not going to recommend anybody to read the book, but in the book there are lots of other examples about lessons we can learn if we're interested.
Okay, I can encourage everyone to read the book, so I suggest you do.
Okay.
So look, thank you very much. It's some great questions from the audience, and
Yes,
and
thank
Richard,
you.
that was awesome. And
Sure.
thank you.